I think that it's very likely that inflation, wherever it settles in, will be higher than what we experienced since the GFC. I think the disinflationary trend is likely over. And for however many decades we got, the runoff from the fall of the Berlin Wall, China entering the global economy. Hopefully I'm not politically triggering anyone, but Roe v. Wade, a lot of women entered the workforce on a global basis. So that, that made the labor force go up. And that's a good thing in terms of pricing. It brings pricing down. Kind of now sort of going in the other direction on a number of those fronts.
Hi, Erin. How are you?
Good. How you doing, Maggie?
I'm doing well. So we're filming this after the release of the August CPI number. Markets are sort of, reacting extremely negatively to them. What's your take on what we're seeing in the data?
CPI is a really tough one. Inflation in general is tough, but with CPI, the challenge is if you've ever dug into the methodology that they use to generate those numbers, it is complex. When you look at it historically, adjustments over the years change how it would have looked at that time. Adjustments that they made even at the beginning of this year. They made some large adjustments to how they smooth owner equivalent rents, which is actually kind of the thing that pushed it higher today. So the challenge with inflation is, number one, it's really hard to predict inflation. Number two, it's hard to predict the data. And number three, it's hard to predict how the BLS is going to change and alter the data over time too. So, in some cases it's kind of a fool's errand, but, when you get down to it at the end of the day, inflation is tremendously higher than any of us want. And it's really unclear when it's going to come down.
And it feels like inflation it's such an important metric right now because it's having an impact on so many different things. And this concern about higher inflation is kind of paramount, right? When it comes to what's going to happen with monetary policy and then the knock on for stocks, for bonds, for the dollar. I know you've been looking extensively at the question of whether we're in a period of higher inflation like we saw in the 60s and 70s. What did you find when you dug into that?
It's really important to think about really what the structural drivers of inflation were, but both now and then sort of compare how they're different. I kind of think about it in really four elements. So monetary policy, obviously, we're laser focused on that right now. Fiscal is clearly a very important element as well. Labor policy and the labor situation is probably one of the most important, and then energy policy as well. And when you kind of dig down into those for the great inflation, so kind of 65 versus 82 is that period of great inflation versus today, I don't think that we're in exactly the same situation. I think that there are some trends that are going on that could push us into that direction. But what it is really informative about that period is it really provides sort of a roadmap in terms of what to monitor. And I think that's what's most useful about it. Monetary policy at the time was very, very different. You can really see that pretty easily in the data. So at the time, there was a tremendous focus on things like monetary aggregates. We obviously still are concerned about that today, QE versus quantitative tightening. But the sort of structure of the economy was very different at the time. Labor was much more important as an influence on prices and wages. Tax policy was very, very different. And then there's sort of this huge component, which is the energy situation, which was also intimately tied to the value of the dollar. Again, some of those sort of trends or factors exist today, but they tend to be pretty different than they were during that period.
So I think it's worth sort of breaking that down a little because so much of the inflation narrative has been really tied to energy, and partly because it's one of the things, as we know, with the war in Ukraine and the supply chain disruptions. I mean, energy was one of the catalysts to drive inflation higher. But it's also kind of tied to the people who believe inflation's here tend to be commodity bulls, right? So there's a sort of trading lens, maybe an aspect that's tied to that too. So we've had a lot of attention on energy, but I think some of the other things you mentioned are really interesting. When you talk about monetary policy or monetary aggregates, first of all, what do you mean? Are you talking about money supply? They used to have things M1, M2, where they used to measure the amount of money in the system. Those have kind of gone out of favor, with a lot of people arguing that there's so much money, so many dollars that sit outside the US that these things are not really maybe as accurate as they used to be. But how is monetary policy different? Or how is that sort of that area? Why is that something we should pay attention to?
Yeah, so it's important really in terms of, so what has been classically thought of over time is the velocity of money. So how often M2 is kind of the de facto metric, how often the money supply changes over a given period of time. So a quarter or a year, however you want to measure it. The velocity of money was much, much higher during the 60s and 70s. And there was really empirically, there was a pretty strong correlative relationship with inflation. So as the velocity of money went up, inflation went up as well, and vice versa. That relationship has really completely broken down since 2000. So there's a tremendous number of reasons for that. In 2020, the Fed put out a piece about this idea of an ample reserve environment. To exactly your point, there's a tremendous amount of liquidity in the system, which is a short way of saying that banks in a lot of ways are really overcapitalized, kind of a hangover from the global financial crisis. To your point about the offshore markets, the development of the Eurodollar market as well. And so there's just a lot more money in the system. I think that a lot of people really since the global financial crisis were really predicting, oh, there's a tremendous amount of money, so we must have inflation. It was just sort of a de facto argument. And I think that that probably would have been the same argument in the 60s and 70s as well. And when you actually look at money supply growth over the last 20 years versus that great inflationary period, it's actually almost exactly the same when you annualize it. It's around 6% per year, up until really COVID, where it spiked sort of through the roof. But we're still not seeing a tick up in the velocity of money, even with the inflationary spikes that we're currently seeing. It's possible we see that over the next few quarters, but it really isn't there right now, which again kind of harkens to this idea of there's just a tremendous number of reserves and liquidity in the system. A couple months ago when Jamie Dimon was on the earnings call for JP Morgan, they announced that they were curtailing their buyback activity. And then he actually had to come back out, I think it was the next day or later that afternoon, and clarify, we're not doing this because of any perspective about the strength of the consumer. It's because we have these regulatory requirements where we need to have the capital on our balance sheet. I'm
going to jump in for 1 second, just in case there are our sophisticated viewers will be completely following you, for just so maybe some of those who don't sort of get into the backweeds of monetary policy. Is it oversimplifying it to say the velocity of money is the money circulating through the economy? And when you say that, look, the reserves are higher, it's that because of regulation perhaps, and because of maybe the way markets operate and just sort of due diligence and fear after what we saw firms failing in the great financial crisis, people sit on more capital. They want to make sure they have a rainy day fund in case something goes wrong, either because the regulators tell them they need to, or because they don't want to get smoked like a Lehman if they have counterparty risk and they want to make sure they're covered. Is that an accurate description of what you're talking about?
Yeah, I think that's fair. And I think it's really fair at the institutional level. I don't know that it's necessarily the case at the individual level, but really more at the
We're all levered
level.
on the individual level.
Exactly.
So that's really interesting, but it was much higher. It was much higher back in the 60s and 70s.
The velocity of money was much, much higher. When you look at, again, some of the other monetary statistics, things like industrial production, manufacturing, those were sort of the telltale signs for which direction the economy was going to move. We tend to be much more services based now. You can tell that in, almost any facet of the market that you look at. We look a ton at the composition of balance sheets now versus decades ago, and there's a whole lot more that's in intangible assets. It's just the way that the economy has moved. And so we need a lot less capital circulating through the system in order to generate GDP growth.
That's a great point, because so when we talk about infrastructure building and in other areas, when we're talking about underinvestment in energy, which is a very hot topic right now, we always talk about the fact they're so capital intensive. These plans are so capital intensive. That's what you're talking about. So we should really, because everyone's been making this argument that that there's been helicopter money from central banks flooding the world with money. Really, maybe you're pointing out we should be looking at the velocity of money moving through the economy. Yes, there's been all this quantitative easing, but it hasn't been circulating in the economy in the way it's actually been sitting on reserve balance sheets, some of it, right? or we're not sure?
A tremendous amount has been sitting on, bank balance sheets, institutional balance sheets. And so
Really important.
yeah, it's very important. It's all relative though, right? Because if regulatory requirements for banks and reserves were to change, then that may accelerate the velocity of money or decelerate it depending on what the regulation was. And sort of then it becomes important. It's sort of the same argument that the Fed gets into all the time of like, what is R star? And even the quantitative tightening experience, the last one a few years ago, they don't really know what the exact size of the Fed balance sheet needs to be, but they've created all these programs around it to sort of create guardrails effectively. Interest on overnight excess reserves, things of that nature. They've created floors for the Fed funds rate as well, which is the reverse repo rate for overnight deposits. So there's just a tremendous number of programs, and it makes it really, really complicated, even for the people that are putting it into practice, to know what exactly the effects are going to be.
Yeah, I mean, you try to read through some of that, and it melts your brain because it's relatively new, right? And so and it's an experiment in real time. But your point about service is very important too, because if you think back to the 60s, I'm going to build a car plant. I need to spend all the money to build the building. Then I need to employ all these people, and then you're going to have. Whereas now, you have somebody sitting in their. I mean, it's the old Silicon Valley, stereotype. It's sitting in their garage, coming up with Uber. And those people already own their car. The sort of capital that you need to build something like that looks totally different.
Right. And again, this is one of those points that I think that kind of by looking back at history, because that's what we do, you can kind of look to the future. So if you think about really all of the companies that have benefited from the monetary largesse, since the global financial crisis, you just mentioned one, Uber. It's really an exercise in removing capital from the business plan. And to your point, during the 60s and 70s, it was really kind of the exact opposite. And so if we were to move into an environment, this kind of gets into things like energy policy and how that's different and where it goes. If energy policy were to start to become different, which it seems like it really has since the invasion of Ukraine, that could cause some regionalization in the global economy. Well, if there's regionalization in energy supply, how does that affect supply chains? I heard someone remark the other day that we've sort of moved from a just-in-time to just-in-case inventory system, which is to basically say that businesses want to have enough on hand so that if something does go wrong, they can still generate revenues. If we start to move to those types of environments, then having more capital available for businesses becomes more important. So then all of a sudden, your cost of capital is a lot higher than it was, a couple of years ago, even 1 year ago today. So all that's really important to look back at history and to really think about how that's going to impact the future.
And we'll come back to that issue in a moment. But the other factor, so monetary policy is different. Labor, I assume you mean the fact that we just had, unions that were powerful back then in terms of collective bargaining, are arguing regularly for wage increases, and that's really dissipated. Certainly in the U.S., it's almost non-existent, but maybe weakening a bit in other places where they traditionally have been strong as well.
Yeah, labor was incredibly important during that time period. And there's this common sort of theory in politics, the median voter theory, which is basically that you can predict where politicians are gonna move based on what the median voter wants. And if you really think back to that time period, so in the 1960s, unions were incredibly strong. Well, why? In the 1950s, we were obviously coming out of World War II. We have things that we all, knew about at the time, like the GI Bill. Well, unionization was kind of part and parcel to that. You then had the rise of communism. And so, in order to fight things like that, there's a bit of a quid pro quo that existed between unions, and the quid pro quo was higher wages. And that also was related to the tax environment. We also had deficit spending, a tremendous number of other sort of factors that existed as well, which sort of caused this thing that the Fed is so incredibly worried about, which is the idea of a wage price spiral. We haven't quite seen that yet, but I think when they look at things like the inflation report today and they see that agricultural costs aren't coming down, that's the type of thing that could cause wages to start really going up. They sort of understand the energy situation at least. But so anyway, long story short, labor is incredibly important. And if we kind of move into this environment, you're starting to see more interest in unionization recently. I know the National Labor Relations Board reported really the highest interest that they've seen in quite some time for the first half of their fiscal year. When you look at the Gallup polls, union approval is polling as high as it did in the 1960s, and disapproval is polling as low as it did in the 1960s. Now, that being said, those polls tend to correlate pretty well with where the stock market's going. So, the previous peaks outside of that were kind of 2008. So, if we continue in sort of this environment where markets are down, financial conditions are tough, which I know the financial conditions indexes say that things are pretty loose, but I kind of find that hard to believe, knowing that the average American mortgage bill is 60% higher if they wanted to go get a mortgage today versus a year ago. So if we get into that sort of environment where things start to get harder on the American worker, I think this trend towards unionization could continue. That doesn't necessarily mean we're going to have instant inflation. These are trends over the course of a generation, but it could be a tailwind if that were to continue.
What are you talking about when you refer to taxes? How is that different?
So I think that taxes, I think that taxes and the impact on inflation is very sort of poorly understood. And it becomes really, really important as tax rates go up. So I think that the common philosophy around taxes is that higher taxes are deflationary. And I think that can be true.
Because people think it kills demand?
Exactly. But when you look at the experience through the Great Inflation, so there was kind of one critical error at the time, which is that there were no cost of living adjustments related to tax brackets. So the average American worker over that time frame, their marginal tax rate went up over 50%. So their wages were going up, but a greater share of it was going to the government during that time frame, which again, that's kind of one of those things that fuels the wage price spiral. But from a corporate perspective, it's really important to kind of think about taxes as really it's kind of a flat tax on revenues, or for the average American worker, it's really a flat tax as well. So it disproportionately impacts lower income people. But for corporations, so let's say you have a corporation that does, let's say, $1,000 a year in revenue. They've got a 10% margin, so they generate $100 in earnings. The average corporate tax rate at that time frame was 48%. So, close to double where we are now. So that means you have a $52 after-tax profit. But if inflation is running at 5%, your after-tax, after-inflation profit is zero. So what's really interesting about that period is kind of what happened during the 1970s. It was a period of conglomeration. And a lot of that had to do with the fact that it was actually advantageous to go out and purchase loss-generating businesses to protect your cash flow generating businesses. So the tax code becomes actually pretty important to the inflation picture during that period. Of course, then the following decade in the 80s was the period of deconglomeration. Everything runs in cycles, The idea that we could possibly continue at 0% interest rates for this extended period of time, when you really look back, it's historically unprecedented. It doesn't exist. So taxes are actually really important. Secretary Yellen came out just a couple of days ago and said that they're going to be seeking higher taxes. With the Inflation Reduction Act that just came out, there's now a corporate minimum tax. The equivalent of the AMT for corporations at 15%. So again, we're nowhere near where we were during that time frame, but there are some things where you're sort of trending. So it sort of gives you a roadmap for what to monitor, I think, moving forward.
So that's so interesting, and I just want to sort of make sure I wrap my head around it. So it's not the short answer is it's not the 70s. There's differences in monetary policy, the amount of money that's really circulating around the economy. We don't have the unionization that we used to have. We don't have the same tax burdens that we used to have. But there are things that also suggest we're moving into a different regime. We can't possibly stay in that uber low, almost deflationary zero interest rate environment. The question then is, where are we headed? So if it's not the 70s, what is it? First of all, are there any historical guides to look at in terms of what it might look more like if it's not the 70s?
I think probably the best guide is probably some sort of a going in reverse almost, where, I think there's a strong argument that could be made that globalization, this multi-decade trend, probably somewhere around 2013, 2014, the Arab Spring kind of stopped or paused or bottomed or something like that. Follow on to Brexit in 2016, along with a number of other European countries that were looking to leave as well. And now greater interest in unionization. So these trends kind of point more towards a less globalized environment. The Russia-Ukraine situation, I would certainly say that prior to that, so in late 2021, I was very much of the opinion, even after the Fed shifted, that inflation was transitory. But once Russia-Ukraine occurred, and it became very obvious that there was sort of a new regime that was moving forward, I think that does push us more into a regionalized economy. You're almost within weeks, as soon as really Russia got cut out of the SWIFT system, you started seeing them establishing other methods for transacting, particularly with Asia. Effectively their revenues from oil have effectively gone through the roof. We saw oil then go to $120 per barrel. So there is a regime change afoot. And I think that COVID probably set the stage for it. It likely would have taken maybe 5 or 10 or maybe even longer for these things to play out, of course, in some other fashion. But the combination of COVID, zero COVID policy in China, Russia, Ukraine, all kind of point towards a more regionalized global economy, I think.
Is a more regionalized global economy inflationary?
I think
by its nature.
I think that it is relative to where we were. And, a great example is this idea of businesses moving from just in time to just in case, where there's a bit of a rush for goods. You don't know if you can secure raw materials. If I'm a mid-cap US company and I'm producing products in Southeast Asia, and I'm not really sure what's going to happen now that the EU is stepping in to potentially make Russian exports uninsurable. How does that impact my supply chain? Do I actually need to worry about hiring a security force to go alongside my tank container cargo of whatever it may be, of wares? I think that all those things point to higher costs.
So let's dive into the energy aspect for a while. So the COVID situation, the war in Ukraine, both expose vulnerabilities, right? But they're not. We don't know yet whether they're structural, right? It's sort of a geopolitical influence that seems to be over us, but highlighting what may have been an unsustainably stretched, very, very fragile supply chain. When it comes to energy, we've got the sort of geopolitical factors, which we can't even use the word transitory because it's just so maligned now and so misunderstood and kind of ruined by the whole debate with the Fed. But you, on top of that, have these sort of years of underinvestment that the commodity bulls point to as like, listen, even if there was a resolution in the situation with Ukraine, even if we took some pressure off of the demand side or the strains, you've got this years of underinvestment that are going to kind of put a permanently higher floor under where prices can go. So they're either going to be sky high or they're going to drift back if the geopolitical pressures ease, but they're never going to drift back that much because we just don't have that now. Do you see it that way, and how significant is that?
Yeah, I think Pandora's out of the box on the energy situation, and everybody has come to the realization that it's more fragile than anybody realized. Certainly Europe is realizing that right now. I think the US is in a really unique position, really because of the shale revolution. So again, in the 1970s, 73 and 78, there were the commodity shocks. Everybody thinks about lines to the gas station, things of that nature. At the time, energy imports as a percent of consumption were like 20%. They actually peaked in 2007. So it got better and then it got worse throughout the period of disinflation. But, again, this was the period of globalization. So the Berlin Wall fell. China was just emerging, the Asian tigers, supply chains were really, really moving around the globe. We peaked in 2007. The US, I think at the time, was producing maybe around 5 million barrels per day of oil equivalent. Now it's 11. So the US actually now is energy independent. When you look at net imports as a percent of consumption, it's actually negative, which is to say that we export technically more than we import. Now, of course, this is another one of those things that can change with regulation. We have the ability to sort of, shoot ourselves in the foot if we want to. Hopefully that doesn't happen. But the situation is very, very different for us, whereas Europe, again, as an example, is just so highly reliant, or was highly reliant on cheap Russian energy. I think that, countries like Japan as well, a huge exporting economy. Germany, obviously, is, you'll probably start hearing the term the sick man of Europe coming back again about Germany because of what's happening with their current account. So I do think it's here to stay. I think that it's really hard to put Pandora back in the box on the energy situation. And what's actually going to exacerbate it is really what we've seen in the last few weeks with natural gas. So I don't think a lot of people realize the energy market. So they basically price on the marginal barrel of oil or unit of natural gas or whatever it is, which is to say that small producers are actually really, really important to the global price of energy. And so the derivatives markets actually relative to the physical markets are pretty small. Like if you go look at NYMEX crude oil outstanding, open interest outstanding, it's kind of in the 120 billion range. We're talking about a market that does trillions of dollars a year in revenue. If you're in an environment where rates are going up and the cost of capital is going up, that means that it's a little bit more difficult to be a trading partner that's not a commercial producer. And you saw this in sort of some of the statements from Equinor last week of this idea of this huge margin call that exists in the energy space of $1.5 trillion. So the worst thing that can happen really to the global economy, because financial conditions are so tied to financial markets, is that we get a bidless market in multiple different asset classes. I'm not saying any of that's going to happen. It's kind of like,
well, it sort of happened last week though, didn't it?
Kind of happened.
In the electric.
In the natural gas market, in the electric market in Europe, where we saw these massive spikes, which are effectively players being thrown out. The term in the industry for it is degrossing. There's too much risk, so they need to get risk off their books, so they are price insensitive and they get out wherever they can. So this is why you have, I think, the European regulators and politicians like getting their arms around this of, well, we don't want to support energy trading companies. What are you talking about? But this is the trend that's existed over the last several decades of we have moved to a services-based, fully financialized economy. So even though this causes so much angst when compared to Main Street and the American worker or the European worker or whatever it is, they're incredibly important. And you can't just make these decisions in a crisis situation based on these principles. It's regulation that needs to be made very thoughtfully over the course of decades, not sort of in the middle of a crisis. So the reason that I bring all this up is I think that fewer players within these markets will cause physical prices to gradually drift higher if we move into some sort of a situation where it becomes more regionalized overall. So you kind of have to look at
That's really, really interesting. I just want to sort of stop and underscore that, because so if you weren't following closely, I think most of us were, but if you weren't following closely what happened in Northern Europe with nat gas and energy. So you're saying that we can almost you're calling it the financialization, which I think is right, but we could think of it also like in a kind of digital way. So you don't have people running around in some open market, like buying barrels of stuff from people and exchanging currency. This is all being done sort of virtually. And there are energy trading firms that are the conduit, right? They are the ones who set the price through derivative markets and sort of grease the system to make it work. And when you're in a highly risky environment right now, players drop out. So in a regionalized, we saw it through the intense situation with the crisis because of Russia and Ukraine. what can happen, which is what happened last week. The government had to come in and backstop them. But you're saying in a regionalized economy now, you're not going to be all connected globally. So therefore you will have less players, and just the cost of doing that is going to be naturally higher.
I think so. Yeah.
That makes a lot. That's very, very interesting. And it makes some sense if, based on the test case we just saw.
At the very least, even if it doesn't result in higher costs, it will require innovation on the part of the major players in almost every market. Consumer markets, energy markets, financial markets. And this is what happens at regime changes. I sit on an investment committee, and we really worry about sort of investing for the last 10 years and whether or not we're still doing that versus investing for what's going to happen over the next 10, because it's so incredibly difficult because of hindsight bias and anchoring and all the behavioral biases that exist. But every piece of data that you look at says that the next 10 years are going to be very, very different than the last 10 years.
Because regionalization seems like going back to something that existed before globalization, but the problem is you're not going back to those exact circumstances, right? Like, you are not going to go back to exchanging barrels of stuff with different currencies and, whatever antiquated way they used to do it before. It's going to require something new. The system we now have doesn't work well in high-risk situations. In highly volatile situations, we found out there are strains, just like the supply chain, where the financial mechanisms don't always work. So something new is going to have to be created in order to sustain that.
Exactly. It'll be some new system that reaches an equilibrium. Whenever you see volatility in any market, all it is price looking for an equilibrium, whatever that is. And sometimes it takes years to figure it out. Sometimes it takes decades. But I think that ultimately over the next whatever period of time, 10 years, whatever, to your point, it's not going to go back to the way that it was in the 1950s or,
right,
pre-Bretton Woods or whatever it is. It'll be something different, but it will be different.
When we're looking at the energy piece of this puzzle, everyone that you talk to on the, I'm going to call them roughly commodity bull side, says, okay, obviously Europe so US is energy independent. But the same question applies because we've got to ramp back up, right? We have to find energy. So we have shale, but a lot of them shuttered, a lot of them pulled down they're operating cautiously, all of that from the experience they had. So whether you've got to re-up the shale production or if you're in Europe, you've got to find a brand new way of doing things. The thought process is that will just take years and years to do. Do you think that's an overstatement? Is it possible solutions are found quicker than people think?
I think that, like as an example, U.S. shale could spin up relatively quickly. I know that there are definitely some arguments against that recently. They're probably looking for more sustained prices, let's say like north of $100 per barrel, but they have the capability to. So, this kind of like dovetails back to fiscal policy and regulation as well. The Inflation Reduction Act as new caps on methane emissions, which previously had really only applied to large oil and gas integrateds. They now apply to the small producers as well. And as we said earlier, energy is priced at the marginal barrel of equivalent. So if all of a sudden there's sort of a new element of cost structure into something that's already an elevated cost structure relative to deep water or whatever it is, that's something that needs to be considered too. So again, we can't shoot ourselves in the foot from a regulatory perspective when one of the key elements in this thing that we're fighting is energy.
I think this is such a useful conversation because we can't be looking backward. We can't look backward for reference. The 70s, while there are some things is not a great reference. Deglobalization is happening, but we can't look back to what the world looked like before that because, too much has changed with technology and information flow, financialization of things. So it's going to look different. And you mentioned really needing to invest for the next 10 years, not looking back. Where are you looking? What do you want to be invested in this type of environment? Originally, I was thinking, where do you want to be invested in an inflationary environment? We may have an inflationary environment, but the thing that comes first is a sort of more regional environment, perhaps a deglobalized environment that may be inflationary, but that's a question mark. from where you stand. So,
Yeah, I mean,
right?
I think that I think that it's very likely that inflation, wherever it settles in, will be higher than what we experienced since the GFC. I think the disinflationary trend is likely over, and for however many decades we got, the runoff from the fall of the Berlin Wall, China entering the global economy. Hopefully I'm not politically triggering anyone, but Roe v. Wade, a lot of women entered the workforce on a global basis. So that, that made the labor force go up. And that's a good thing in terms of pricing. It brings pricing down. Kind of now sort of going in the other direction on a number of those fronts. So I guess, so the question is where to invest now? So if you're in an environment where all of a sudden capital costs more, what you don't want to be invested in is all the stuff that did so well over the past 10 years, all the huge beneficiaries of monetary largesse, which, it's actually really amazing how quickly actually the market adapted to the Fed's November press conference of doing away with the word transitory and starting to talk about quantitative tightening and raising rates, where within weeks, something like 40% of the NASDAQ, I think, was moved to 52-week lows or something along those lines. All of those names that had negative profits were immediately derated, 20, 40, 50 plus percent. It was quite remarkable how quickly it actually happened. So you don't want to be in what we kind of think of as low quality companies, which we sort of think about it from really three different perspectives. So quality of earnings. So you want to make sure that companies are generating cash. You really want to stray away from companies that are using things like non-cash items, things like accruals in order to boost their earnings. Because ultimately somewhere down the road, there's going to be a asset write down or a downside earning surprise. So there's kind of like the quality of earnings. We think about the balance sheet, so financial strength. You don't want to be owning over-leveraged companies in an environment where financial conditions are tightening and rates are going up. Now, that's not to say there's never a time to be owning those firms, but if they're too far out on the spectrum, then that could be an issue. And those that are heavily reliant on outside sources of capital to support their balance sheets, so with lots of debt and equity issuance, particularly on the debt side, that could be an issue. And then you really want companies that the businesses are actually healthy. You want companies with larger margins that have pricing power, because ultimately, if you move into an environment where there's either volatility or inflation, you want them to have the ability to pass on the costs of those raw materials onto customers, or to deal with inflation. So that's kind of quality. This sort of the three of those I think of as the collective idea of quality has really just done terribly since the global financial crisis. I think that probably fundamentals start to matter again moving forward. And, so that could be an interesting place to be. Value has actually outperformed for the first downturn since the tech bubble. I think classically, a lot of people actually do think of value as sort of this kind of more defensive strategy that does better in downturns, where that actually had really not happened since the tech bubble. It was really kind of a vestige of pre-tech bubble that was the case. But again, the economy was very, very different then. And so now it's kind of interesting to see value doing well again. And I think that in this type of environment, if volatility is higher and inflation continues to move higher, on the cheaper side of the ledger could be an interesting place to be as well.
Mm. Do you sacrifice innovation if you stick with value?
It's a good question. If you look back at really historical cycles of innovation, what you find is there's sort of like a watershed moment, which you can only identify, in retrospect.
After the fact, sadly.
Yeah, right, exactly. Tech bubble is an example. We all made fun of pets.com. Well, it was turned out to be a pretty successful business 20 years later. Point being, all of this innovation, it spreads to every aspect of the economy. It takes time to diffuse through the economy. I'll give you us as an example. We're an asset manager. We spend a tremendous amount of resources and money on servers. Well, that's how we manage money. So we've incorporated all of this technology, all of this code, all of this development into the way that we run our business versus, let's say we were a firm in the 1970s that we were doing it, we'd be all doing it by hand or on the
With a
floor,
pencil.
as you mentioned earlier. Exactly. And you saw the exact same thing happening in retail. Kohl's, Coors, as Amazon was eating their lunch, they were trying to get rid of all their physical space and floor space, and they were trying to reinvest it in Silicon Valley centers to develop their websites. So all this technology diffuses through the economy. You can go on to, I can't remember the name of the website, but you can track tankers throughout the world now because they have these geolocation devices. So all of this technology, it's not that you don't get access to it by investing on the value side of the equation. You're just kind of at the later stages of it, effectively.
So that's so interesting that you say that, because I was at the SALT conference in New York yesterday, and I was sitting in a private credit conversation, and it sounds like what you're saying is, in that environment, for the retail, and so for the individual retail investor, the sort of average investor maybe, that in this kind of environment, in this new regime that we're talking about, you might be better off further downstream, right? Like with the value companies, with the established names, with the proven track record, with earnings. Does that mean leaving the sort of unicorn hunt for the sort of deep-pocketed investors that have much more tolerance for risk and can afford to lose a lot more on the hopes of finding the one company, because they will have no future earnings? They will be levered. I mean, that's the only way to grow a company, right? Or do you think that those companies grow under the umbrella of existing companies now and don't the startup culture changes?
It's an interesting question. I do think the startup culture and the private markets will change. There is going to be a lot less leverage sort of easily available, less liquidity easily available. It's possible that it could now happen under the umbrella of parent companies, because there's this other sort of interesting dynamic about how is a corporation for which executives today are really inexperienced with this, how do they deal with inflation? I heard somebody remark on the radio the other day of, now all of a sudden the CFA Institute needs to brush off all their books on LIFO and FIFO accounting, because it actually matters when inflation is running high in terms of what your earnings are going to be, and all those that are analysts. So executives are really, most of them, the vast majority of them, are untested in inflationary
Absolutely, because it has been like this for, as long as most of them have been out of business school or in the early days of their executive career. It just hasn't, we've been in a deflationary, disinflationary period.
And in that type of scenario, you can continue to pile on debt and it doesn't matter, because your debt to cash flow ratios continue to look good no matter how much you pile on. Now, there are obviously extremes. I'm being hyperbolic, but you can do it pretty consistently as a source of capital. And when rates are low, there's actually, a decent demand for yield. But it also sort of brings up this idea of, how do you manage cash in an inflationary environment? So let's look to, the bellwethers, mega cap tech, Apple, Google. I don't know how much exactly they have cash on their balance sheets right now. Maybe it's $200 billion. I don't know.
Like more than most nation states, though, right?
Exactly. If inflation's running at 8.3%, you've lost 8.3% of after-tax purchasing power. So all of a sudden, holding a tremendous amount of cash becomes really suboptimal. So, long way of saying, to your point, maybe they decide to go out on an innovation spree. Maybe they go on an acquisition spree. Again, we saw this happen in the 1970s. You are incentivized not to hold cash. You are incentivized to go out and purchase things. We saw the same thing in terms of worker compensation. The 70s is where perks came from, because for the highest marginal earners, which could be 90%, depending on where you fell, you don't want W-2 income. If you're an executive, you want to fly on a jet and have that not pass through to your income. So, again, part of what makes this situation so different is we haven't experienced it in multiple decades, And it's so multifaceted. That's sort of why when I think about it, you got to think about the monetary, which I think so many people are focused on the monetary. We're kind of really at peak monetary right now. But the Fed and central bankers have really come out so many times and basically said, like, in the best way that they can, like, we can't fix this alone. In a lot of ways, it's a fiscal situation. It's a policy situation that needs to be resolved. And unfortunately, this is also something, I would say there are probably more policymakers that are familiar with the 1970s than there are executives.
Well, if you look at U.S. Congress, they should be, but we don't know if anybody's memory's working because they're getting so far up there.
Yeah, right.
And then who knows?
Right.
I mean, the average age is like what? I mean, it's crazy, as opposed to Europe, where you've seen some very young people take over. But
so, hopefully, I think, policy is going to be very, very important over the next decade.
And what would be the policy? What should they be doing?
It's a huge question. It is way above my pay grade.
Yeah,
but
it's so complicated.
It's so complicated. But you mentioned it a little bit earlier. We haven't had a major infrastructure boom in this country in decades. We haven't done the equivalent of building the interstate system. So infrastructure, things like that become more and more important. We need to be careful about things that are sort of backdoor price controls, because those can be inflationary as well. I saw a headline the other day, there's a bill in California that there's going to be a state board that sets minimum wages in the state. That is a de facto price control to the extent that those things start to exist across the global economy. Europe is debating that for Russian oil and gas. So we just have to be careful that the policies that we're enacting are not reactionary to the current situation as opposed to truly being forward thinking.
Because we don't know, we know we're not going to be in a disinflationary, or your theory is that we will not be in a disinflationary or deflationary period, but we don't know what, it's also not likely we're going to be in a hyperinflation period like the 70s. So we don't know what it looks like. We don't know what the inflationary period looks like. Is there such a thing as a Goldilocks inflationary situation where, because deflation is not good. I mean, Japan has been fighting deflation. I mean, so there is, it's not that is a desired effect either. Is there a situation where we could see some level of healthy inflation? Is that a thing?
So yeah, healthy inflation is surprise, right? Where the Fed's target is, it's around 2%. And you can actually, everybody wonders where that comes from. It did just kind of magically pop out of the air. But if you look at the stock market back to, the 1920s, and you do a distribution in terms of deciles of inflation, the lowest, to your point, is deflation. It's kind of like negative 2%. The highest is around 11%, which is kind of some periods in the 20s and 30s in advance of the Great Depression. Then also in the 1970s, and right in the middle is about 2%. And when you plot on top of that, the average equity returns over that period, they peak at about 2%. It's about 20% average nominal. And then they sort of tail down from there. So Goldilocks is a relatively healthy amount of growth and a decent amount of inflation. Inflation, to your point about disinflation, is terrible. It's way worse than inflation. But inflation is actually something that it kind of keeps the cogs of the economy actually going. I mean, can you imagine if, your wages were exactly the same as they were in, let's say, like 1990? Now, unfortunately, some people are in that position, and that's why they're very unhappy. But so a healthy amount of inflation sort of throughout the economy is actually kind of the wheels that keep our economy going, because really following the tech bubble, as we sort of got to this tail end of disinflation, we became a debt-based economy. And you can see that in any of the metrics that you go through. The GFC, you see sort of the chart of private debt sort of tail down and public debt come up. It's got to go somewhere. And just as was the case coming out of World War II, the US debt to GDP ratio was around 130%. The way we got out of it was, number one, Bretton Woods, and number two, by having massive amounts of inflation, because we really didn't have fiscal surpluses until the 2000s. So that money wasn't paid back. We inflated our way out of it. So what the global economy really needs right now is nominal growth to pick up. That's really what the world needs right now.
Yeah. And as you're talking about that sort of healthy level of inflation, it occurred to me when I was talking about Goldilocks, it does have a name. It's called price stability, which is the Fed's mandate, right? So
Right.
they're not saying
2%.
there
Yeah.
is no inflation. They're saying they want to keep it in some sort of level. We've been talking about equities. Do you own bonds in this kind of environment?
It's really tough. I think that, again, this is another thing. We were talking about the value dynamic pre 2000 versus now is kind of the first time that value has protected on the downside. This whole mantra that we sort of live in as allocators of there being this negative correlation between stocks and bonds is actually an aberration. It's existed since 2000, but prior to that, it was very common for stocks and bonds to move together. So I think that what you're seeing, particularly on days like today, because now you're starting to see that positive correlation, it's a risk premium coming back into bonds. When you own a bond, let's say you buy a bond at issue, you know what its return is going to be on a nominal basis. The only thing that impacts that return for you, assuming it's a government bond and you're assuming that it's risk-free, is inflation. And so if you don't know what inflation is going to look like, you don't know what your bond is worth, and hence you're going to get volatility. We know equities have a risk premium, even though it's low currently relative to historical standards. It's certainly ratcheting up, but we're moving into an environment where there's going to be a risk premium in bonds as well. And so I think that there will be more fits and starts on the fixed income side of this positive correlation with equities. A lot of the next few years, I think, really kind of hinges on the next few quarters, particularly what happens with, unfortunately, monetary policy, which I don't think they even know what they're going to do. They've probably got a plan that they're not totally revealing to us. But until that happens and they sort of see the data come in, I think that the way that we are managing clients' expectations is volatility is going to be a persistent sort of factor in markets, at least for the foreseeable future, in a way that it was not over the past 10 years. We don't know where the market's going to be over the next 3, 6, 12 months, 5 years. We think over the long term, it'll continue to be up. But volatility, as the globe effectively works through all these issues, is going to be higher.
And when you say the next 3 or 4 months or 5, it's 6 months is going to determine everything. It's because whether they're successful about getting inflation under control. Is that what it hinges on?
I think so. I think if we get to a point where you start seeing CPI prints of 6%, 5%, 4%, then the question is going to be is where is it going to level out? And I think that that's just a different question than the one we're facing, which is, though we've peaked and there have been 2 prints that are lower, there's still more pressure in there, I think, than expectations have led to. Certainly, today is a perfect evidence of that. When you go down 3% on a 10th over print or whatever it was. So there's a lot of angst that exists in the system about what inflation is going to look like over the next few quarters.
Last question that we haven't talked about. Do you look at currencies? The US dollar has just been strong, getting stronger, and a lot of concerns about what that does, because a super strong dollar is referred to as a wrecking ball. It can be really difficult for the global economy.
It is. Honestly, I'm shocked that the equity markets are as high as they are against this backdrop of a stronger dollar. I think that there are probably some things that potentially on a short-term basis are pushing it higher. This whole situation in Europe that we were talking about earlier in terms of the energy markets, that tends to lead to flows to safe haven assets. And if bonds aren't your safe haven asset anymore, obviously the stock market is down 10%. Dollar strength can sort of suck up all that liquidity. We were talking about the offshore, dollar market being so large. If that is the case, which it is when you look at the flow data, then where do you put those assets? You put them in US dollars. And so that sort of trade will have momentum as long as it does until it reverses.
Yeah, and watch out for that.
It definitely is one of the most crowded trades. I think when you look at, sell side analyst reports, it's one of the most crowded trades. And so at some point, usually when you see that and they start hitting the 90th, 95th, 99th percentile, it reverses pretty strongly. Maybe that correlates with when the Fed is done or there's more clarity around the inflation picture. Who knows? But the dollar is definitely a wrecking ball. There's no question. And I think that right now, the recent strength is probably some knock-on effects with what's going on in Europe and those assets seeking safe havens.
Ehren, this has been such a fantastic conversation. Thank you so much. I mean, we're at, it feels like an inflection point, and these are going to be a couple critical months that determine, much of what happens in the coming year. With inflation being right at the center of it, really appreciate all the thoughtful conversation and analysis around it.
Of course, it was a lot of fun. Thanks so much for having me.
That was such an insightful conversation. My takeaways from the talk with Ehren. Number one, he does not think this is the 70s all over again. There are just too many differences in monetary policy, labor, and taxes. With regard to monetary policy, I thought his focus around money velocity in the 70s versus today was really interesting. The service nature of our economy, which is less capital intensive, paired with the regulations that mean banks keep way more capital on their books, are both really important differences that he pointed out. Number two, it's not the hyperinflation of the 70s, but we are also not going back to the disinflation, low interest rate environment either. He thinks the pandemic and the Russia-Ukraine war have pushed us into a more regionalized decade where inflation will be more elevated. How elevated or how high? That depends on a number of things, including whether the central banks have the ability to bring down prices. His guess is they can't do it alone. They will need help on the fiscal side, and the next 3 to 4 months will be critical. Ehren says the focus every day is to try to invest for the next 10 years, not the last. So number three, observation, things are going to be different. He thinks that value stocks present the best option right now. Fundamentals will matter in this new regime. Companies with proven earnings, healthy balance sheets that are not over-levered are going to outperform in his view. Pay attention to company management as well. Many executives haven't ever had to navigate an inflationary environment, which is true if you think about it. Also, keep an eye on acquisitions. This is really interesting. In a higher inflation environment, you're not incentivized to hold cash. So companies with huge balance sheets like Apple may be more motivated to do deals. So not the 70s. There's not an easy historical comparison. He thinks we're in a new regime. We are going to see elevated inflation. Where it lands, though, depends on a lot of different factors. The Goldilocks scenario, you guessed it, the Fed's target around 2%, which is why their mandate is price stability. Hope you enjoyed the conversation.
Hey there, revolutionaries. To join a community sharing insights like you just watched, head over to realvision.com. There you will get unbiased insights and exclusive access to the very best, brightest, and biggest names in finance. Be a part of our community of lifelong learners. See you there.